a reduction in supply and therefore an increase in price in palladium, a double in the price of palladium, would have no near-term measurable impact on demand, because that $150 worth of palladium allows you to sell a $40,000 car. The upside potential in the event of a supply disruption is amazing.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest-growing companies. SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Rick Rule, President of U.S. Sprott Holdings. Rick, thank you so much for joining us today.
Pleasure to be with you, Elijah. Thank you.
All right. Now, last time we had you on, you were pretty excited about the Barrick and Randgold merger that was coming up. This would have created the largest gold company in the world. This went through, and now we have the largest gold company in the world. So what does this mean for the mining sector?
The Barrick-Randgold merger was interesting in that it probably, or at least hopefully, kicked off a fair bit of rationalization in the mining and gold mining business. As we discussed in the initial interview with regards to mergers, they have the potential to do many good things. The first is that the industry suffers from way too much general and administrative overhead. And one of the things that can happen in a merger is that you eliminate duplicate overhead. That's, of course, very difficult on the people who get eliminated. But from the shareholders' perspective, it's often an unalloyed good. The second thing that happens, of course, is that larger companies enjoy more liquidity and often higher market caps, which is a different way of saying that mergers lower companies' cost of capital. They also allow, through the application of management and capital against a larger asset base, to more optimal capital allocation. Finally, what happens is that the merged companies very often sell a range of assets that they're less interested in, which allows those assets often to find management teams that lavish more care and attention on them. And finally, of course, the redundant people that get let go by the merged companies often find more productive employment in other circumstances. I'm reminded sort of 20 years ago of the Barrick acquisition of Placer Dome and the fact that Sprott was able to add both Andy Jackson and Neil Adched to our roster, which was hugely useful to Sprott and to its clients. So I think that these mergers are an unalloyed good.
Still on the topic of mergers, there's the latest merger is the Newmont merger with Goldcorp. How will this impact? What is your perspective on this merger, and how will this impact the gold mining sector?
Well, hopefully this is just a continuation of a trend. The initial indication of success will be how much duplicate overhead the Newmont Goldcorp merger will be able to eliminate. There is a very large Goldcorp operation in Vancouver and a very large Newmont operation in Denver. Hopefully, the companies won't have two headquarters, and hopefully, looking through the personnel that come into the merger from both companies, the management teams will be able to select the best people and continue in that regard. I've noted that the combined companies believe that they can eliminate $100 million in duplicate overhead. My hope is that they can find a way to increase that to $200 million a year. And you will note that $200 million a year in overhead savings is the equivalent in terms of its contribution to EBIT margins of a very large gold mine, except for one that doesn't necessarily deplete or depreciate. Saving $200 million is as good as making $200 million, particularly because the benefit from it, if you are disciplined, is permanent.
Now, what is the difference in the gold mining sector of the impact between mergers and acquisitions?
I think really very little. I think they're names. A merger of equals is or an alleged merger of equals is probably more difficult to cause to occur because the entrenched management of the side that is going to come out as the junior partner, which is to say going to lose their jobs, isn't offset by the benefit to shareholders that comes from a large premium. In other words, a merger means that two groups are coming together ostensibly as equals. An acquisition means that one group is obviously coming out on top. In an acquisition, very often the shareholders of the party that is acquired enjoy very large takeover premiums, which doesn't often occur in what are suggested as mergers of equals.
Now, moving forward here into the gold market, we've seen since pretty much the beginning of the year, quite a rise in precious metal markets. What is your perspective on this recent rise, and where do you see them going for the rest of the year?
Well, I think it's fairly obvious, given what I do for a living, that I'm a bit of a gold bug. As we've discussed in interviews before, I believe that the gold price is in large measure a function of global sentiment as to the ongoing purchasing power of the U.S. dollar. The U.S. dollar has been less strong, which means that gold has been more strong. My own suspicion is that rising U.S. debt levels and an economy that has been in expansion for 9 years, and therefore an economy that is long of tooth, might presage less U.S. dollar strength, which would be very good for the gold price. I'm not one of those who either suspect or want the gold price to be $2,500 or $3,000 overnight. The circumstances that cause very rapid appreciation in the gold price are invariably very bad for everyone's standard of living, my own included. But I am one of those who believes that the U.S. dollar will be relatively less strong in the future, and gold, therefore, will be relatively more strong. It actually amuses me as to how little a move in the gold price excites the gold faithful. If you talk about a $100 move in gold from $1,200 to $1,300 as an example, in percentage terms, it isn't an enormous move. And it tells you something, the amount of excitement that a $100 move has generated. What could happen to gold equities prices if the gold price, and probably more importantly, the silver price, were to begin to move more aggressively? One thing I note, and I don't know this because I'm not an economist, but my suspicion is that if we halt the increase in U.S. dollar interest rates, that is, the Federal Reserve gradually withdrawing liquidity from the markets, or if as a consequence of higher rates, we had a dramatic enough economic slowdown that they had to decrease the interest rate, then I think that you would see the pace of gold price increases really accelerate. I'm not suggesting this is going to happen. I'm just saying it's a factor to watch out for.
Now, with respect to the mining sector, can you give us an update on how the mining sector has been impacted by this recent rise in both the gold and silver prices?
Thus far, it doesn't appear to have been, at least, I should, let me start the answer over. Particularly as an example for the Australian mining sector, where their inputs are measured in Australian dollars, but their output is sold in US dollars, and where the Australian dollar continues to deteriorate against an already deteriorating US dollar, there's been some very welcome increase in margin. The truth is that the increase in gold prices in a global sense has not thus far materially impacted the operating margin that the gold mining industry enjoys. And I guess the consequence of that is that the impact of the increase on gold prices on the equity prices of companies that produce gold hasn't increased materially either. It's important to note, unfortunately, that in the period 2000 to 2010, when the gold price increased from $260 an ounce to a high of $1,900 an ounce, that the cash flow per share in the gold mining industry actually declined. It took real skill to show decreasing cash flows per share in the face of a six-fold increase in commodities prices. One hopes that the lesson that the gold mining industry and gold mining investors learned in the last decade will allow us to take advantage of what I see as a fairly strong gold price environment coming up over the next 5 years.
Now, moving to other precious metals, we're looking at also palladium. We've recently had all-time record highs for palladium. What is your perspective on, why palladium has been rising so much recently?
Well, to begin with, it rose from a very, very oversold base. Palladium got crushed over the last decade. And the consequence of palladium getting crushed meant that investments in new palladium production didn't take place. And the existing palladium producers had to reduce their sustaining capital investments, which reduced supply pressures on palladium. At the same time, the sales of gasoline-powered cars increased because the global economy did reasonably well, at least for the last 6 or 7 years, and did well particularly at the expense of diesel cars. This is important because platinum is the catalytic converter material for diesels, while palladium is the catalytic conversion material for gasoline. So the increase in gasoline's market share as a fuel for internal combustion engines exacerbated the price rises in palladium. It is interesting to me that 5 years ago, when the price of palladium had to go up, nobody cared. Now that the price of palladium has doubled and it doesn't necessarily have to go up anymore, everybody's fascinated by it. It always amuses me that metals investors are most interested in the horse that's already flown the barn. That's the illustrative and educational part of the palladium story, which interests me the most.
Last time we had you on, we were talking about the South African situation with respect to mining. Do you think the mine strikes in South Africa could have an effect on the palladium market?
I think the mine strikes in South Africa will have a dramatic impact, or could have a dramatic impact, on both platinum and palladium mines. Also on the deep gold mines, because the circumstance is virtually the same. The uncertainty as to the ultimate ownership of allegedly privately owned economic interests in South Africa over the last 20 years has meant that the mining industry, particularly the precious metals mining industry, has not invested sufficient sustaining capital in the deep platinum or palladium or gold mines. These are very labor-intensive mines, partly as a consequence of government policy. The workers are paid abysmally low wages. The wages have to go up, except that the wages can't go up because the mines lose money. The mines have suffered from an extraordinary lack of sustaining capital investment because the owners don't know how long they're going to continue to own them. So there needs to be a dramatic increase in sustaining capital investments, except for they can't do it because the mines don't make money. So we're stuck in this case literally between a rock and a hard place. The ANC government believes that they have to back the unionized miners who are engaged in what is currently an uneconomic exercise. Literally billions of dollars need to be invested in these mines to mechanize the mines. Mechanizing the mines, of course, leads to lower employment, which is politically unpalatable and goes contrary to the current theme in South Africa, which is redistributing wealth to the black majority as a consequence of the heinous former regime's stealing of black wealth for decades. The ultimate consequence of this is either going to be real free market economic reforms or a precipitous decline in platinum production, palladium production, gold production, and, by the way, the South African economy.
And if we see, in platinum, palladium, and gold, the production declines, that could that cause a shortage in the markets?
I don't think you'll see a shortage in the gold market. Remember that new mine supply is, sort of 1.5% of total supply. Almost all the gold that's ever been mined still constitutes supply. Platinum and palladium are very different. When platinum and palladium get mined, they don't get thrown into a hole in the ground called a vault. They go up a smokestack or out a tailpipe. They get used up. So a circumstance where South African platinum and palladium production were constrained either by long-range economics or short-term politics or a strike, that could have an immediate and a very dramatic impact on platinum and palladium prices. Let me give you an example. At current palladium prices, it takes about $150 worth of palladium in a catalytic converter to sell a $40,000 car. The impact of the price of palladium relative to the finished price of the vehicle is absolutely inconsequential. Reduction in supply and therefore an increase in price in palladium, a double in the price of palladium, would have no near-term measurable impact on demand because that $150 worth of palladium allows you to sell a $40,000 car. The upside potential in the event of a supply disruption is amazing. And there are not very many abilities to substitute. Platinum and palladium, really, in terms of the supply that matters, comes from South Africa, troubled, Zimbabwe, disastrous, and Russia, recovering from a very low base. So the markets for platinum and palladium are unusually vulnerable to political disruption in any major producing area, but particularly, of course, because of its importance to supply, vulnerable to disruptions in South Africa.
And so you're saying, there's massive upside potential because, the demand, it won't change much with regard to the price. But when it comes to downside potential, what is it there for platinum and palladium?
That's a great question. I think there's a couple kinds of downside potential. The first is that we have been in a synchronized global economic expansion. Never mind that it's been a weak expansion, U.S.-led, for about 9 years. I'm not an economist, but in my lifetime, an expansion that lasts 9 years is long of tooth. If the economy softened and we went instead from global economic expansion to a global recession and vehicle sales began to taper, that would, of course, hit demand for platinum and palladium both pretty hard. The second is that palladium began to gain market share against platinum when platinum prices were higher than palladium. In other words, fabrication technologies evolved that favored palladium over platinum because of the price advantage enjoyed by palladium over platinum. Now that the circumstance is reversed, now that palladium prices are so much higher than platinum prices, what you will begin to see is fabrication technologies in pollution controls, emissions, and catalytic converters that begin to favor platinum over palladium, because the prior situation, the prior price advantage enjoyed by palladium over platinum, has now been reversed. So I think those two things could be harmful to the palladium markets.
All right. Well, moving on here, one last topic I'd like to discuss is about the dollar. What is your perspective on the dollar for 2019? Do you see weakening occurring? And if so, how could this impact the precious metal markets?
I think you need to say weakening compared to what? The strength in the dollar over the last 3 years, I'm convinced, hasn't had to do with a fundamental strength in the U.S. economy. As much as it's had to do with weakness in competing currencies. Doug Casey famously said that the dollar is the prettiest mare at the slaughterhouse. So while the American economy, one could argue, has been strong mostly on the basis of liquidity, other economies have been absolutely weak, and the dollar has done well against such anemic competitors as the yen, the yuan, and the euro. I think we may be coming into a circumstance where the dollar joins some of those other fiat currencies as the inherent weakness in the U.S. economy, at least the U.S. economy's ability to sustain the debts and the deficits that our American community has rung up, begins to be apparent. The narrative around the United States, the jobs growth, which doesn't take into account the people who aren't looking for work, as an example, or the liquidity engendered by the tax cuts, which doesn't take into account the deficits, which are funded by borrowing, are all chickens that come home to roost. And if the discussion begins to evolve around arithmetic rather than narrative, that would be very, very bad for the dollar. It's important to remember that it's very difficult to end up with a positive sum by adding a column of negative numbers. And the truth is that our fiscal policy very much involves that sort of alchemy, where you add a whole bunch of negative numbers and then you print to cover the deficit, and of course live happily ever after. At some point in time, I suspect that game's going to be called, and that would, I suspect, be damaging to the dollar and quite good for gold, and by the way, probably better for silver.
All right. Well, Rick Greuel, thank you so much for your time today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
I would love to be contacted by your viewers whom I enjoy visiting with. The easiest way to reach me is at rrule, that's RRULE, at sprottglobal.com. As I often do as an inducement, if your listeners and readers will send me a copy of their natural resource portfolio, importantly with the names and symbols in the text, so that an old man can access them, I will rank those portfolios and return them by email. An apology to the people who sent me their portfolios after our last interview. You may know that I underwent hip replacement surgery right after that. So my responses to some of your readers were much slower than I would have preferred. But as I say, if you email me your natural resource portfolios with names and symbols in the text to rrule, that's RRULE, at sprottglobal.com, I will rank your resource stocks and send them back to you by return email. I look forward to visiting with as many of your readers as would like to take me up on that offer.
Awesome. Rick Greuel, once again, thank you so much for your time.
Pleasure, Elijah. Thank you.